Why investing in banks pays off. Investing in the stock market is a popular way for individuals to grow their wealth over time. However, with so many different types of stocks available, it can be challenging to determine which ones are worth investing in. One option that investors may want to consider is banking stocks. Banks play a crucial role in facilitating financial transactions, allocating capital, and providing liquidity to businesses and households. As such, they are critical institutions that are essential for a healthy economy. By investing in banking stocks, investors can gain exposure to the broader economy and potentially benefit from steady growth opportunities, attractive dividend yields, and diversification benefits. In this article, we'll explore the key reasons why investing in banking stocks can be a good option for investors. We'll also take a closer look at the different types of banks that are available in India, as well as the potential risks and rewards of investing in this sector. Reasons to invest in banking stocks. Steady growth opportunities. Banks tend to be reliable and stable businesses that generate consistent revenue streams. As a result, investing in banking stocks can offer steady growth opportunities over time. Banks are also well positioned to benefit from economic growth, as increased economic activity typically leads to higher demand for financial services. Exposure to the broader economy. The performance of banking stocks is often tied to the broader economy. As the economy grows, banks tend to benefit from increased lending, transaction volumes, and other business activities. This makes investing in banking stocks a way for investors to gain exposure to the broader economy and potentially benefit from economic growth. Attractive dividend yields. Many banking stocks offer attractive dividend yields. This can be appealing for investors who are looking for a steady stream of income from their investments. Diversification benefits. Investing in banking stocks can be a way to diversify a portfolio. This is because banks are part of many different industries and sectors, and their performance is often tied to broader economic trends. For example, a bank may have exposure to the real estate sector through its mortgage lending business or to the technology sector through its digital banking services. Resilience to economic shocks. While banks can be impacted by economic downturns, they tend to be more resilient than other sectors. This is because they are often backed by strong regulatory frameworks and have the ability to adapt their business models to changing market conditions. For example, during the COVID-19 pandemic, Indian banks were able to quickly adopt digital banking channels to serve customers remotely. Government support. In many cases, governments are willing to provide support to banks during times of crisis. This can provide an additional layer of protection for investors who hold banking stocks. Overall, investing in banking stocks can be a good way to participate in the growth and stability of the banking industry, while also diversifying a portfolio and potentially generating income. However, it's important to keep in mind that investing in banking stocks also comes with risks, such as interest rate fluctuations, regulatory changes, and credit quality issues. As with any investment, it's important to conduct thorough research and analysis before making any decisions. In India, there are several types of banks available to investors, including public sector banks, private sector banks, foreign banks, regional rural banks, cooperative banks, payments banks, and small finance banks. Risks of investing in banking stocks. Banks are complex institutions that are exposed to a variety of risks, both internal and external. Some of the key risks associated with investing in banking stocks include interest rate risk, credit risk, regulatory risk, and operational risk. Interest rate risk refers to the risk that changes in interest rates will impact a bank's profitability and cash flows. Credit risk refers to the risk that borrowers will default on their loans, leading to losses for the bank. Regulatory risk refers to the risk that changes in regulations or laws will impact a bank's operations, profitability, or capital requirements. Operational risk refers to the risk that a bank will experience losses due to inadequate or failed internal processes, systems, or external events. It's important for investors to be aware of these risks and to conduct thorough research and analysis before making any investment decisions in the banking sector. Interest rate fluctuations. Banks' profits can be significantly impacted by changes in interest rates, which affect their borrowing and lending costs. If interest rates rise, banks' borrowing costs can increase, reducing their profit margins. On the other hand, if interest rates fall, banks may earn lower interest income on their loans and investments, again impacting their profitability. Regulatory changes. Banks operate in a highly regulated environment, and changes in regulations or government policies can have a significant impact on their profitability. For example, increased capital requirements or stricter lending standards can increase costs for banks, while reduced regulations can lead to increased competition. Credit quality issues. Banks are exposed to credit risks, which can result in losses if borrowers default on their loans. Economic downturns or industry-specific factors can increase the likelihood of loan defaults and impact banks' earnings. Market risk. Like any other stock, banking stocks are exposed to market risks such as fluctuations in share prices due to changes in market sentiment or other macroeconomic factors. Technological disruption. The banking industry is evolving rapidly, with the adoption of digital technologies and the rise of fintech companies. Banks that are slow to adapt to these changes risk losing market share to more innovative competitors. Reputation risk. The banking industry is highly dependent on public trust and confidence, and any negative news or events can impact a bank's reputation and stock price. So, investing in banking stocks can be a wise move for individuals looking to gain exposure to the broader economy, steady growth opportunities, attractive dividend yields, and diversification benefits. But, remember to conduct thorough research and analysis before making any investment decisions. Remember, investing involves risk and there is no guarantee of returns. It's important to approach it with a long-term mindset and a diversified portfolio. And most importantly, never invest more than you can afford to lose. Remember, this is not a recommendation, but rather an educational resource for learning about investing and personal finance. Thanks for watching. Please subscribe.